All right. Thank you everyone for attending this month's market update webinar for the month of August 2024. Let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can check out our website for additional disclosures. And throughout the webinar, please use the Q&A button at the bottom to submit any questions you may have, and I'll answer them at the end. A quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, certified private wealth advisor, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in personal financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary RIA, registered investment advisory firm. We provide comprehensive wealth management services, including financial planning, investment management, tax prep, and estate planning. You can learn more about us on our website. All right, so this month I wanted to start with what we've done so far this year in the markets, and then show you what was different this month, since this month was a little bit of an anomaly in comparison to the rest of the year. This year, we can see the big, brightest green bubble right here is NVIDIA. So NVIDIA is a semiconductor manufacturer, computer chips manufacturer, and they're up over 100% for the year. There's trillions of dollars of market cap growth in a very, very short amount of time. So it's honestly carrying a lot of the market, especially what we call the mega caps. So the really, really largest companies out there, so Facebook, Google, Amazon, Apple, Microsoft, NVIDIA, they have really been the ones that are outperforming in the market, up 20% year to date, which is incredible. The S&P 500 up 16%, but again, since the S&P 500 is what we call market cap weighted, so the larger companies have a larger impact on the indices, a lot of those gains are just from the top 7 companies. The Dow Jones is calculated slightly differently. It's more of a value index and usually underperforms, or at least in the past 10 or 20 years, underperforms the S&P 500 and other indices that hold more tech stocks and more higher growth stocks. Small caps underperformed the larger caps, which what we expect. We had some problems with banks and such before, and a lot of those fall into what we call the small cap category. So still small caps up 9% for essentially 6 months is very good, a very good return for the year. But in comparison to the 20% of mega caps, it's been underperforming. Further underperformance in global markets, so non-US stocks only up 6.1%. Historically, they underperform. I have expected that they would continue to underperform. I expect they will continue beyond now to underperform. There are some structural reasons why the US markets are stronger than, say, the European markets and some other markets in Asia and such. Bonds up 2% for the year, total return, doing fine. Bonds aren't really expected to go up or down too much, but I would have hoped the bonds performed a little bit better than they have. And I do expect them to start performing better as we expect rate cuts in the future, which helps bonds have better returns, at least in the short term. Gold was another really big winner this year, up 20%. If you remember the past 2 years, gold had been lagging, especially in an inflationary environment when gold is usually very strong. And I had continuously mentioned, well, it's a little strange that gold hasn't been doing that well, even though it's in a prime position in the market to do well. But this year has made up for it. Gold up 20%, doing well. Crude oil up only 9%. Crude oil can be very volatile. So 9% is not much for the year. It's actually been tamped down a little bit because of the fight against inflation and crude oil leading to a lot of costs in gas and transportation costs for shipping and for airlines and for production of different plastics and all the different things that you buy at the grocery store that contain plastic. Crude oil trickles down through all of those costs. So since rates have risen to combat inflation, it's not surprising that oil has not been going crazy as we've seen sometimes in the past. And Bitcoin up 55% for the year, doing quite well. A lot of those returns came at the beginning of the year when the spot Bitcoin ETFs were approved. I've discussed that in past webinars, but recently Bitcoin's been having some more downward volatility, some bad returns, but year to date have been doing quite well. So now that you know where we've been, where most of these really large gains are coming from just a few companies, we want to see what happened this month. And it's kind of what I expected. Last month, I had warned that we were getting a little bit over our skis. It was getting a little bit too frothy in the market, too much hype. Some of these companies that had been up 100% or 200%, they just kept going up and people kept buying them. Eventually, that can't be sustainable forever. So this month, all those companies, the mega caps that have been driving the market, had some sell-off. And we'll get to some of the reasons why near the end of the webinar. But you see all the big companies except for Apple here, Microsoft down, Nvidia down, Google, Facebook, Amazon, all these very, very large companies were down. And you see that the mega cap for the month, it was one of the only numbers here that is negative. So we had a big reversion back to small caps, which was the big winner in a month, 10% returns. If you remember, year to date, we were 8%. So we were negative year to date, excluding this month. And this month made up all the returns, roaring back, trying to find some more value that was forgotten because everyone was excited about these very, very large companies. Other than that, Bitcoin, gold, everything is kind of acting as I expect. It's trading normally, but it's really interesting to see the difference between these mega caps and the small caps and how what had been driving the market at the beginning of the year is not necessarily what's going to drive the market for the rest of the year. For those of you that saw various panicked headlines or news stories about the stock market crashing, especially on Monday, where there was a lot of panic, I want to show this larger graph to show that there were some volatility. There was some volatility in the markets, but it's nothing to be extremely concerned or panicked about. We see that we've had 3, let's say, downward corrections, which I would consider this just to be a stock market correction, not a crash. Crash has is a strong word that panics people often. But we see this was definitely a faster decline than some previous ones. August, September, October of 2023, we had a pretty bad time, but it was a slow fall versus the past half month, essentially, we saw a big sell-off. But that came after a equally big rise in June that, in my argument last month, was somewhat unwarranted. Not that much changed, yet the market went up by a lot. So when the market goes up by quite a bit in a short period of time, it's not unheard of or unexpected or worrisome for the market to correct itself, to go back to where it was. That's why I put these lines out here. We're back down to where we were in May, which was an all-time high almost, and we're still well above where we started 2024. So those that are panicking that the world is falling or the sky is falling and that everything is going to change, remember where we were. Try to zoom out a little bit. Don't look at just the day chart or just the week chart or just the month chart. Look at the year or a year and a half, as you can see here, where we're up quite a bit from where we were, and not to be too panicked, to remember that investing is a long game, that trying to trade the markets or time the markets often historically has shown to be folly. Just sticking with it and passively investing has been shown in various academic financial journals that that's the best way to invest. Moving on, I wanted to show this chart that I show every single month. The outside circle shows historical returns over the past 70, 80, 100 years. 1950 to 2017 is this data. And it shows the cyclicality or the seasonality of the markets, where some months historically are simply better than other months. There are a lot of reasons: how earnings are timed, how various events are like rate cuts are timed, how like we have seasonality for like Black Friday and Christmas shopping. All of these can affect markets. And August and September historically are the worst 2 months. June, this month, we matched what we would expect. We got 1.1, and it was expected to have a 1% return for the month. And August and September start having some problems, and then we usually finish out the year October, November, December better. Now, of course, that's not guaranteed. Markets, this is a trend over 70 years. It isn't necessarily what will happen every single time. As you can see in April, April is usually the strongest month in the first half of the year, but this year we had a negative 4% return, the only negative month out of all of these months. And June, we usually have, it's a coin flip if it's a positive or negative. We have a negative 0.1. Same thing with May. We had really strong months here. So even though it's a good guide to help tamper expectations and to understand what might happen if there is no large, what we call black swan events that affect the markets and drive the markets, if they just act normally, don't be panicked if we see August and September to be weaker months. And I feel that that will continue to be true because we had such a strong beginning of the year. Year to date return, we're looking at 15.8%. Annualized, that's 30% almost. We shouldn't expect 30% returns in the markets. So we'll probably end up giving up some of these returns in August or September. With that said, you shouldn't try to time the market by selling out, because I could be wrong. Again, these are trends. So just sticking through it. If you have liquidity needs, what we call short time horizons, if you're planning on buying a car with the money that you're investing in the stock market, that shouldn't be in the stock market. The money that's in the market, you shouldn't need for 10 years or more. So you shouldn't be worried too much about the day-to-day or week-to-week or month-to-month volatility in the markets. All right, so now we're getting into some of the more fun parts. Other than just talking about the market, I always like to talk about the notable events that happened in the month. And the first two have very little impact for any of you listeners, but I wanted to bring them up because they were very interesting, at least for me, interesting financial news for the month. So the big first one was that Envestnet was taken private. So private equity company Bain Capital, with help from BlackRock, Fidelity, State Street, and Franklin Templeton, as minority investors, strategic partners, they went and bought the public company Envestnet and are taking it private. For those of you who have never heard of Envestnet, don't be surprised. It's not a well-known company for those that are outside of the financial world. Envestnet is a huge player in the wealth management space. They have important financial fintech software that drives and runs most of the financial world. A lot of the largest companies use Envestnet software. So they have financial planning software, Money Guide Pro. I've used that in the past. They have portfolio rebalancing software called Tamarack, which is considered one of the best portfolio rebalancing softwares out there. They have account aggregation software, Yodely, which is often in the background of a lot of your favorite, you know, user software. So like some of your banks might be using Yodely in the background to allow you to link various accounts so you can see them all on your login screen. And they have many other smaller software products that cater to the wealth management space and the finance industry. Well, Bain has bought them, and again, it probably doesn't affect you very much, but the expectation is they're probably going to unwind some of these holdings that this big conglomerate has and sell off some of the smaller pieces and refocus the company on its most profitable product offerings. That's what is usually expected from private equity companies. It's not always great for the company that is acquired or the employees of that company. Some get fired, some get moved around. But for the investors, so Bain Capital and the four strategic minority investors, the goal is to create value for their shareholders. So we'll see. I don't know if I'll ever bring it up again in the webinar, but from our side, it'll be interesting to see how these software packages that are very important in our financial advisor, financial planner space change over time. The other big M&A news that was coming this past month was Google, or Google's parent company, Alphabet, attempted to purchase cybersecurity startup Wiz for $23 billion. Now, for those of you who have never heard of Wiz, I'm the same. I had never heard of it before this was announced. Especially, I was surprised since it's a $23 billion company I'd never heard of. They're a very young company. I think they're like maybe less than 3 years old. They're very, very young. Being valued at that is crazy to me. But they're a cybersecurity startup. And a lot of the Fortune 500 is now using them. And they have really good revenues and really good growth. So Google wanted to snap them up and add it to its cloud offering. Unfortunately for Google, Wiz declined the purchase offer and are reportedly planning on trying for an IPO instead. So initial public offering, going to the public markets, being publicly traded is their ultimate goal, apparently. It's interesting also to see that Google went after Wiz and was declined. This comes after Google had walked away from acquiring HubSpot either last month or a couple months ago. They walked away from HubSpot because they had antitrust concerns. They didn't think that the M&A deal would be allowed by regulators. But it's clear that Google has a large pot of money that it is actively trying to use to buy something. And I would not be surprised if in the coming months you see another notable event that I bring up that Google has attempted or successfully or failed to buy a large software company and add it to its portfolio. We shall see. Moving on to some more notable events. The first one I really want to cover was the good news on inflation. June was the first negative month-over-month inflation month. So we've had some months that had zero increase in prices month over month. May was one of those months where it stayed flat. But June, we finally started going backwards a little bit. So some of the prices fell. Again, you probably didn't notice it. It is, an aggregation of a lot of different products and services, but it's good to see that inflation has mostly gotten tamed from the Federal Reserve's increasing rates. Now, the next big concern is how long until the Federal Reserve starts cutting rates, because if they hold rates at a restrictive level, which they currently are at, the fear is eventually it'll put the economy into a recession. So the expectation is the Federal Reserve will have the first rate cut, a 25 basis point rate cut, next month in September. But we'll see if they end up doing that. They could do more. They could skip next month. They could do a 50 basis point cut, but the expectation is they will do a 25 basis point cut and continue that for each month for a while until they get to whatever level they're comfortable at keeping it at for a while. With the negative 0.1% month over month, we got to a flat 3% year over year. So that's the quoted inflation rate that you'll see some news headlines say. So we finally got to back to 3%, which is normally where we want to be at. We want to be between 2 and 3. So it needs to go down a little bit more, but at 3%, a lot of economists are saying we have succeeded. We got there, which is good to see. The probably biggest news of the month that was not just finance news was the CrowdStrike incident that happened on July 19th. What I found really interesting is for those of you who were here last month and saw the notable events, I don't expect you to remember, but one of the events was 3 companies left the S&P 500 and 3 companies were added to the S&P 500. And one of the companies that was just added to the S&P 500 in June or July was CrowdStrike. And so now there's a new S&P 500 inclusion. What did they do on July 19th? Well, they pushed a faulty software update to their customers, which crashed about 8.5 million computers running Microsoft Windows and their software. And it caused widespread disruptions, which affected airlines, airports, banks, hotels, hospitals, gas stations, governmental services, and lots of others. You probably had some sort of affected service that you're trying to do. You might not have realized it was caused by CrowdStrike. I specifically remember that day I was trying to order through my Chipotle app for my dinner, and it just would not go through. So we all had difficult times that day, of course, somewhat worse than others. I'm sure those that had flights canceled or delayed, or those that had problems because some hospital computers had it worse than me missing my Chipotle. But thankfully, a lot of the disruption has been mostly fixed. The problem is a lot of it had to be done manually, and there's still some computers are still out there that are still bricked by CrowdStrike's faulty update. Most of those are more minor systems. The most important critical systems have been fixed by now, but it definitely was not good for CrowdStrike stocks. CrowdStrike stock was down 30%, which was about 25% more than the broader S&P 500, the broader market. But it really was a terrible time for it to be included in the S&P 500, because that means just about every single American who has a 401k, who has a little bit of money in the S&P 500, had at least some level of losses because CrowdStrike made a mistake, which is unfortunate. And then the last news story I wanted to cover this month was just happened. It technically happened in August. So even though this is a backwards, so we usually talk about July in August. This happened on Monday, which was what I'm going to call the Monday stock market correction. A lot of news headlines have been calling it a stock market crash. I prefer to not use the word crash in this scenario because, again, we were inflated quite a bit, so we were correcting back. And also, crash definitely makes people more panicked and worried and stressed. And I'd prefer for those of you that are listening to not be too worried about this. A lot of the problems, which I will explain in a second, have resolved themselves or at least tempered themselves, and it's less of a concern, even though it was pretty scary Monday morning when some stuff was down 8% for the day, which was not great. So on Monday, the market crashed and or corrected, and there were about 4 reasons that I came up with on why it crashed. Trying to come up with why is always interesting in this job, because no one knows. There's always a million reasons. There's a lot of market participants. There are a lot of market participants looking at different data, they each have their own self-interests that are causing them to make their own moves. But as an aggregate, these were the four main drivers. So the first one is analysts saw some weak economic data in the jobs report and some other economic health indicators, which essentially is making them worry that the Federal Reserve has waited too long to start cutting rates. And if people are getting laid off and there aren't enough new jobs being created, we could go into recession, which would cause problems in earnings, company earnings, which would then translate to lower stock market returns. The second big reason were that because of these difficult indicators or unhealthy indicators or potentially unhealthy indicators, analysts are, again, worried about the company earnings. So we had earnings season come out for Q2 in July and going on now as well. And there were some worries that, well, we had some good growth, but will that growth continue, especially with some of the problematic economic data? It wasn't that bad, but they always are looking forward and are trying to get ahead of the curve and see, they want to sell before everything starts crashing. But they don't ever know, they might sell too early. It might not crash, it might just keep going up. So that was 1 and 2. 3, which I briefly mentioned, was the fear that the Federal Reserve was waiting too long to begin cutting rates, which could force us into a recession if they keep it too highly elevated. Now, the fear on the stock or on the Federal Reserve's side is they're only at 3% inflation, which is great, but they want to get it below 2, and they don't want to start cutting rates. And when you cut rates, inflation could come back. And they really want to beat inflation and keep it down and not have to worry about it resurging right after they start cutting rates. So there's two perspectives there. Now, with those 3, those are like normal economic, just stresses. The fourth one is going to take a little bit of time to explain, but it's definitely the most interesting. So the fourth reason why on Monday there was a lot of volatility, fear, crashes, whatever you want to use as a word, was because Japan's central bank raised their interest rates for the second time since 2007. Now, many of you might be thinking, why do we care if on the other side of the world, Japan changes their interest rates? Why does that affect our market so greatly? So you got to understand what Japan is. Japan's economy is very different from ours. They've had lower growth. Their demographics are very different. They have very old population. They have low birth rates. The companies, again, grow slower. And there are a lot of other reasons. But what that translates to is they've had very, very, very low interest rates for over a decade. In some instances, they had negative interest rates where you go to the bank and you'd have to pay the bank to hold your money. In comparison to when we go to our banks, they pay us interest. So what this environment, this negative interest rate environment, allowed US investors to do was go to Japan, go to their banks, go to their companies and such, and borrow money in Japan at near zero interest rates. And then they'd convert those Japanese yen that they just borrowed into US dollars. And then they would go and buy high-flying tech stocks on the US stock market. And by investing this essentially free money, has zero interest or very, very low interest, and then buying lots and lots of stocks that are just keep going up and going up. And if it was going up last month and you expect it to go up next month, why don't you just go out and borrow more money from Japan so that you can buy more NVIDIA? Because NVIDIA is up 100%. Why isn't it going to be up another 100%? So you can see the fear, the FOMO, the fear of missing out of, well, I can borrow money for near zero rates and we're just going to keep doing this. So these strategies are called carry trades or interest rate arbitrage. It's nothing that you should be worrying about too much. It's more so like institutional investors and hedge funds doing some of this stuff. But after Japan raised their interest rates, which wasn't by a lot, but it raised it by enough that it made these strategies either no longer profitable or much less profitable with much more risk. So all these market participants very quickly had to what's called unwind their trades or cover their trades so that they could cover all the debts they had to have in Japan. So they sold off the high flying tech stocks that they bought and covered their debt. Even though it was low interest rate, they still had to repay it. So after they had unwound their positions, we see the translation of the market crashed or the market corrected. We're going to probably see continuing slight problems, I guess we can call it, or just continuing unwinding some of these positions that have caused the stock market in the US to become frothy, or some people would say overpriced or overhyped, or whatever word you want to use. But I want to drive home the idea that I'm going to swing back a couple slides. We're still not that far down from where we were. It's nothing to really be concerned about, and I do expect the next 2 months that this trend might continue and we might continue giving up some of these gains that we've had, but it's not guaranteed, and you shouldn't be panicked about it. Sticking with the market long term, investing passively, not trying to time the market, not trying to stress too much about what the hedge funds are doing by doing interest rate arbitrage and borrowing yen and then converting it and then buying stuff. Like, don't worry about all that stuff. I will keep looking at it. I'll keep you updated if any of these things happen again in the markets that are worthy of bringing up in our little webinar here. But don't worry too much. Yeah. So time for Q&A. I had seen 2 questions come in about the arbitrage and about the Japan and the carry trade and all that stuff that I mentioned at the end that caused some of the crash or the correction. But I answered those in my rambling about the Japanese markets. So I don't need to cover those 2 questions. And I haven't seen any others come in. One's a personal question, and you can send me an email if you want to discuss that. All right, well, I don't see any other questions coming in. Thank you all for attending this month's market update webinar. I hope to see you back next month. Hopefully I'll have good news for you. I wouldn't be surprised if we see the market down and I have some bad news for you. But again, don't stress too much about it. Yeah. All right. I will see you all here next month. Have a great one.